Hey everyone, this is Ron Sneller, founder of Sneller Financial Services, coming at you today from my home office. Now, for video number 2 in our 7-part series, The 7 Deadly Sins of Retirement Planning, we are going to focus on no spend down strategy or not having an exit plan. Now, the 7 deadly sins are: number 1, no holistic plan; number 2, no spend down strategy or exit plan; number 3, being too focused on growth rather than income; number 4, not having a volatility buffer; number 5, not being risk smart; number 6, mistakes with insurance; and then number 7, having no strategy for taxes. Now, today I'll share my thoughts on number 2, not having a spend down strategy or an exit plan. Now, in the last video, the first part of the blog series, I discussed the importance of having an overall holistic plan and beginning with the end in mind. Now, when people begin accumulating money in their IRA or in their 401k, they most often do so with no understanding of how the distributions work, either from a risk standpoint or from a taxation standpoint. So instead of beginning with the end in mind, and what I mean by that is having a goal of how much retirement income they want, and then planning and utilizing the proper products to get there, the average Joe just begins stuffing as much money as they can into their employer-sponsored retirement plan. Again, I don't fault anybody for doing the best they can with the knowledge they have to start accumulating some resources for the future. But if you fast forward 35 years, now we have somebody who's getting ready to retire. And what I find is that pre-retirees, they know how much money they have. They just have no clue, no idea what to actually expect from that money. You know, a 2008 study by MetLife showed that nearly half of all baby boomers who were surveyed thought that you could safely withdraw 10% from your retirement portfolio every year. Well, you could do that, but you would just run out of money real fast. So, what is the safe withdrawal rate from a managed portfolio? 5%? Nope, too much. 4%? You know, even 4% fails 20 to 30% of the time now. So, what is the bulletproof withdrawal rate? Well, according to the Wall Street Journal, it is just 2.2%. 2.2. Although a 2013 study by Morningstar and the American College of Financial Services, they found that you could generally consider a 3% withdrawal rate to be safe. Now, look, let's rewind a little bit. You know, since the 1990s, financial advisors have been promoting the 4% rule. Now, this is based on the research done by William Bengen and the Trinity studies, and their findings led to the conventional wisdom that retirees should invest their portfolio in 60% stocks, 40% bonds, and 4% withdrawals per year. Now, this basic assumption is what most of the Monte Carlo simulations were based on. But here's the thing. These old rules, they no longer fit our new reality in this millennium. You see, those studies were done prior to 2000. So pre-dot-com crash, pre-9/11, pre-financial crisis, pre-mortgage meltdown, and before the Federal Reserve thought it would be just a great idea to artificially keep interest rates at zero for over a decade. So nowadays, because of all the stock market volatility, because of the persistently low interest rates on savings and short-term debt instruments, if someone continues to withdraw 4% from their portfolio every year, there's a 20 to 30% chance that they'll run out of money before they die. You know, I was recently reading a study by Morningstar that said if somebody happened to retire at the wrong time, and then in the first year of retirement, they had a 25% loss to their portfolio, there would be a 59% chance that they would run out of money before they died. They would never be able to make up for that loss. Now, this is called sequence of returns risk, that you lose money early in your retirement. And if that happens, it is absolutely devastating for a retiree who is drawing income out of a managed money portfolio. And here's the thing. Nobody can predict it. Nobody can control it. Not you, not me, nor any other financial advisor on the planet. And so the 3% rule, that is the safe withdrawal rate to pace yourself throughout retirement to make sure that you don't run out of money. And I've said it before, but it bears repeating right now. I want you to imagine this. You are a millionaire. You have been one of the lucky few to save and invest and accumulate $1 million in your 401k or in your IRA when you retire. But can you imagine being a millionaire and having to pace yourself by living on just $30,000 from your investments? I mean, you could do that if you want. And if you would be happy doing that, then more power to you. But is it the optimal way to structure a retirement income plan? I would argue no. A comprehensive retirement income plan is a much more advantageous strategy. And I'll briefly describe two that I find very, very valuable. Now, the first strategy is called the flooring method in some circles. This strategy aims to cover all of the basic expenses with guaranteed lifetime income sources. Those would be things like pension, Social Security, and some form of an annuity. And then in an optimal situation where we have enough resources available, we would even utilize some guaranteed lifetime income sources to cover the discretionary or the recreational spending as well. Retirement expert Tom Hegna refers to this concept as paychecks and playchecks. Okay? So again, Social Security is an important tool for that strategy, as is a defined benefit pension plan, if available. Now, any shortfall for the immediate income needs are funded with a non-correlated asset class to distribute regular cash flow. Now, depending on the situation, I like cash value life insurance or some kind of income annuity or fixed index annuity. Now, once the spending needs are met, with the rest of the remaining assets, they can be invested for long-term growth potential and to offset the effects of inflation. Retirement expert Curtis Cloak refers to this as buying income and investing the difference. Now, a second strategy is in some ways very similar. This strategy is called the bucket plan. Now, this strategy divides retirement assets into three buckets, three separate and distinct buckets of money. The first bucket is the now bucket. This is for an emergency fund. This is for planned expenses, like if within the first year or two of retirement, if you have to buy a new car, or if you know that you're going to have to replace the furnace or the roof, something like that. And then up to 1 year's worth of income. You know, for those planned expenses, what we know that we'll need, there's no sense in investing that money. But we'll need that money in too short term of a time horizon. And then, of course, we want to have emergency money there as well. Because if you have that now bucket fully funded, think of how much better you can sleep at night, okay? So that's the now bucket. Then we have what's called the soon bucket. Now, the soon bucket, this is short term. It involves protecting and preserving 10 years of income plus an inflation adjustment in low to no risk vehicles to optimize the short-term income goals or the short-term spending goals. Now, this can range from bond ladders to fixed index annuities. I've even heard of people utilizing preferred stock in this bucket. But again, this is low to no risk, and the purpose is to generate income over the first 10 years of retirement. And then the third and final bucket is the long-term bucket. These are investable assets designed for more than 10 years away. Now, due to the long time horizon, this portion of money can be invested with a focus on growth. And then about 5 years before the short-term bucket is exhausted, we peel off some of the profits from the long-term investments, and then we refill the short-term bucket for the next round of short-term spending. The creator of the bucket plan philosophy, Jason Smith, he refers to this methodology as buying a time horizon and investing the difference. The beauty of both of these strategies is that once the immediate and short-term income needs are met, the remaining investable assets can be positioned even more aggressively for growth. If desired, of course, depending on the individual's goals, time horizon, and risk tolerance. But because we have an emergency fund established, because we have short-term planned expenses, we have money set aside for that. And for the next 10 years, we have all of our short-term spending goals and income needs met. With this long-term bucket of money that's invested really aggressively, yeah, we might see some near-term volatility, but it's not a significant disruption to the overall plan because these investments won't be needed for they won't be needed for the short term. So in doing this, we take the emotions out of it, the behavioral finance. We take that out of it because the investor knows, look, even if the stock market does go down 25, 30, 35% in my first couple of years of retirement, I don't have to panic. I don't have to sell. I don't have to bail on our plan because I have all of my short-term spending goals met, and I can let this other long-term bucket of money recover, keep it invested for the future, because over the long term, the stock market does work out. It does tend to grow and the assets go up. So again, these strategies help the investor retire with confidence and stick to the long-term nature of the plan. This strategy, or either one of these strategies, it leads to immediate gratification because we have the income available, a higher rate of return on the long-term investments because we're in it for the long term. We can commit to a long-term strategy, and that leads to overall improved happiness and improved retirement outcomes. So there you have it, folks. I've briefly laid out a couple of methodologies that will generally perform much better than retiring on an IRA where it's all positioned in a managed money account and taking distributions of 3% per year. The methodologies that I've described can provide more after-tax spendable income with less volatility, less worry, and more predictability and more certainty, while still growing a portion of your money for future spending goals or even for leaving a legacy. The earlier that one begins planning for this, the more advantageous it is. So if this strategy, if it sounds like something that would benefit you, please don't hesitate to contact me. And don't forget to tune in to the next entry of this video series, Deadly Sin number 3, people being too focused on growth rather than income. We'll see you next time. Thanks for tuning in.